Welcome to This Explainer. Today, we are diving deep into Learning Module 2, Analyzing Income Statements. We're going to trace the fascinating journey of a single dollar, from the exact moment it hits the top line as revenue, all the way down through the gauntlet to the bottom line. Along the way, we're going to unpack the rigorous accounting rules and standard practices that dictate how profitability is actually measured. If you've ever wondered how analysts strip away all that reporting noise to find a company's true economic engine, well, you're absolutely in the right place. So let's jump right in.
Here is our roadmap. To make sense of these complex standards, we're following a logical top-to-bottom flow that mimics the actual layout of an income statement. We'll recognize the top line, manage expenses, filter out the noise, calculate EPS, and then analyze the big picture.
All right, starting right at the top, recognizing the top line and revenue principles. The golden rule here is that revenue has to be recognized in the period it's earned, which, as we know, might be totally out of sync with when the cash is actually collected. So it all hinges on this concept of the performance obligation. Basically, revenue recognition means identifying the precise moment control transfers from the seller to the buyer. For a simple retail swipe, boom, it's instantaneous. But what if you're a middleman? Well, if you act as a principal, meaning you actually take control of the goods before selling them, you report the gross revenue. But if you're just acting as an agent, connecting a buyer and a seller, you only report your net commission. Throw in complex multi-year contracts, and this whole process suddenly requires a ton of judgment. A perfect example of this is a long-term contract. Take AVI's multi-year deal to build a $10 million weapon system. It takes 2 full years to build. They don't just sit on their hands and wait until year 2 to book all that revenue. Instead, AVI uses the proportion of costs incurred to measure their progress. So in year 1, since they incurred 60% of the estimated cost, they go ahead and recognize 60% of the revenue, which is $6 million, and 6% of the profit. It's a highly objective way to smoothly match real-world economic activity with financial reporting. Now, what about a bill and hold arrangement? Imagine a customer buys custom armored vehicles from AVI, but literally has nowhere to park them yet. Can AVI still book that revenue even though the vehicles haven't moved an inch? Actually, yes, but only if they meet some seriously strict criteria. The customer has to have a substantive reason for the request, the product must be separately identified and ready to go, and, this is key, AVI absolutely cannot redirect those vehicles to another buyer. If you check all those boxes, control has transferred and the revenue is officially earned.
Moving down the statement, we hit Section 2, Managing the Matching Principle for Expense Recognition. The overarching rule here is tying costs directly to the specific revenues they helped generate. To see just how massive an impact accounting choices can have, let's look at 2 hypothetical companies making the exact same equipment purchase. Cap Inc. decides to capitalize the cost, spreading it out over the asset's useful life. This delays the expense, which makes their current profits look amazing, but it acts as a drag on future profit trends when depreciation kicks in. Now Inc., however, expenses the whole thing immediately. Their current profits take a huge hit, but with no ongoing depreciation, their future profit trends look incredible. It's the exact same underlying economics, but it creates 2 wildly different income statements.
So, with all these accounting choices clouding the waters, we hit Section 3, Filtering the Financial Noise. Before we can judge a company's true core operations, we have to isolate the non-recurring items. As analysts, we have to play financial detective and hunt down these specific categories, which thankfully are usually reported separately. We're looking for unusual or infrequent items, discontinued operations, which, by the way, are always reported net of tax, fluctuations from exchange rates, and changes in accounting policy. And a quick side note here, it's absolutely crucial to distinguish between a change in an accounting policy, like switching how you value inventory, versus a change in an accounting estimate, like just tweaking the expected useful life of a machine. They are handled differently. But we isolate these anomalies because they distort what the business can sustainably do going forward. It really boils down to this idea. The ultimate goal is to strip out past anomalies, to build a rock-solid, accurate forecast of what the company is actually going to earn next year and the year after that. Which brings us to Section 4, Calculating Earnings Per Share. Once we've cleared out the noise, we arrive at the bottom line metric that equity investors obsess over the most. The math here comes in 2 flavors. Basic EPS is pretty straightforward. Net income minus preferred dividends divided by the weighted average common shares. Easy. But if a company has a complex capital structure, think stock options or convertible debt, we have to calculate diluted EPS. This requires us to pretend that all those convertible securities were actually exercised. We expand the share base in the denominator to show current owners the absolute worst-case dilution scenario for their slice of the pie. But here's a fun wrinkle to test your grasp on the rules. What happens if you do all that theoretical math for diluted EPS, and assuming the conversion actually makes the EPS go up instead of down? Well, let's look at Dimcool Utility Company. Their basic EPS is $3.10. But when we run the if-converted method on their preferred stock, adjusting the numerator and the denominator, the resulting EPS pops up to $3.13. Because that $3.13 is higher than the basic $3.10, the security is flagged as anti-dilutive. And the accounting rules are very strict here. Anti-dilutive securities are entirely thrown out of the diluted EPS figure. So Dimcool's reported diluted EPS just stays at $3.10. Remember, diluted EPS is purely about showing a conservative, worst-case scenario. All right, finally, Section 5, analyzing the big picture. We've traversed the whole statement, and now we need to zoom out and evaluate the entire machine using common size analysis and profitability ratios. The big challenge is figuring out how to compare a tiny startup with a massive global conglomerate. By using common size analysis, we express every single line item as a percentage of total sales, which completely neutralizes the size difference. Look at this. In pure dollars, Company C looks tiny with $2 million in sales next to Company A's $10 million. But common sizing levels the playing field, showing us that Company C generates the exact same 20% operating profit margin as Company A. Dollar for dollar, the little guy is operating with the exact same efficiency. And we always pair that visual analysis with key profitability ratios. We generally drop these into two buckets. You've got return on sales metrics, like your gross and operating margins, which show how well management controls expenses relative to revenue. Then you've got return on investment metrics, like ROA and ROE, which reveal how effectively management is using the company's assets and equity base to actually generate those profits. Put them together, and you get a fantastic read on management quality. So the next time you pull up an income statement, I want you to ask yourself, are you just blindly accepting that reported EPS at face value, or are you using these tools, spotting capitalized versus expensed costs, stripping out the non-recurring noise, and running the common size numbers to find the true sustainable economic engine hidden underneath? Because I promise you, the difference between those two approaches is the difference between just reading a piece of paper and actually understanding the business.